All right, so we're diving deep into equity REITs today. You actually requested this deep dive, and honestly, who wouldn't be intrigued? Imagine owning a piece of a skyscraper, or maybe even like a shopping mall, but without the headaches of being a landlord, right? That's the power of equity REITs. And we've got your research here, a whole stack of it. And I actually spotted something in there about them legally having to share most of their profits with investors. Now, that's what I call a juicy detail, right? But before we get ahead of ourselves, let's break down the basics. What exactly are equity REITs?
Well, equity REITs are companies that own or operate or manage income-producing real estate. And the key word here is income-producing. Think steady cash flow from rents, not flipping houses for a quick profit.
So it's less about HGTV and more about like building a real estate empire without the DIY drama.
Exactly, and your empire can be surprisingly diverse. Equity REITs can hold everything from apartment buildings and office towers to shopping centers and even things like cell towers.
Cell towers? Wow, that's fascinating. I never even thought of those as real estate investments. Okay, so they own a wide range of properties, but how does this benefit someone like you? What makes this 90% profit-sharing rule so special?
Well, with equity REITs, you're essentially becoming a passive investor in a portfolio of properties. You pool your money with other investors, the REIT buys the properties, and then they handle all the management, finding tenants, collecting rent, dealing with repairs. And because they're legally required to distribute at least 90% of their taxable income as dividends, you get a consistent share of those rental profits.
So it's kind of like owning a tiny sliver of like hundreds of different businesses, all generating rental income that gets paid back to you regularly.
That's a great way to put it. This consistent income stream is one of the biggest appeals for REIT investors, especially compared to the the unpredictable world of traditional real estate.
Okay, that makes total sense. Now, you mentioned that these REITs can hold a variety of property types. So what are some of the main categories we're talking about here?
Well, we can break them down into a few key categories. Residential REITs focus on housing, and that's not just your typical apartment buildings. Think student housing, which is a market that's constantly growing with each incoming class, or senior living facilities catering to the needs of an aging population. Demographics play a huge role here.
It's like each generation fuels a different sector of the real estate market. Makes you wonder what the next big trend will be, right?
Nah.
What about commercial real estate? I imagine office buildings must be a big part of that.
Commercial REITs are definitely a major player, and office buildings are certainly part of the mix. But this sector is undergoing some interesting shifts, right? The rise of e-commerce is creating both challenges and opportunities. For example, traditional mall-focused REITs are having to adapt, while industrial warehouses catering to these online giants like Amazon are seeing explosive growth.
It's fascinating how something like online shopping can send ripples through the entire real estate landscape. What other types of properties fall under commercial REITs?
Well, you've got hotels and resorts, which fall under the hospitality sector. These are directly tied to travel and tourism trends, which can be volatile but also offer the potential for high returns. And then there's healthcare. With an aging population, the demand for hospitals, nursing homes, and medical office buildings is only going to increase. REITs focused on healthcare are tapping into a powerful long-term trend.
So many different options. It's like a buffet of real estate possibilities. You also mentioned something about specialty REITs earlier. What makes them so unique?
This is where things get really interesting. Specialty REITs venture into less conventional areas like data centers, which are crucial for our digital world. Self-storage facilities, which, they always seem to be in demand. And even infrastructure like cell towers. It's a reminder that real estate investing goes far beyond just houses and apartments.
I'm starting to see why you called it a real estate empire. But even empires have their challenges, right? What are some of the risks involved with equity REITs?
Of course. No investment is without risk. One of the most important things to remember is that REIT prices can be volatile. Just like stocks, they're influenced by the overall economy, interest rates, and even investor sentiment.
So they're not immune to market swings?
Not at all. And we can't forget about those sector-specific risks we discussed. The success of retail REITs, for instance, can be heavily impacted by consumer spending habits and the rise of e-commerce. The performance of hospitality REITs is tied to travel trends and can be vulnerable to unexpected events like global pandemics.
That's a great point. It seems like staying informed about broader economic trends is crucial for REIT investors. Are there any other risks to consider?
Absolutely. Remember that REITs are businesses and businesses can face challenges. You want to look at factors like the quality and location of their properties, their occupancy rates, which essentially measure how full their buildings are, and their debt levels. A REIT with high debt could be more vulnerable in a downturn.
So it's not just about the type of property, it's about the health of the underlying business.
Precisely. And that's where understanding key financial metrics comes in.
Perfect. Let's move on to those metrics then. Okay, so we've talked about the risks, talked about the allure of these REITs, but how do you actually go about evaluating them? It feels like there's, a whole financial language to learn.
There are definitely some key metrics to consider, but don't worry, we can decode them without getting lost in, all the Wall Street jargon.
That's a relief. So where do we begin?
One of the most crucial metrics is funds from operations, or FFO. You'll often see this instead of just net income when you're analyzing REITs.
FFO, okay.
Yeah.
Why is that so important for REITs specifically?
Well, with real estate, you have things like depreciation and amortization, right? Which are essentially accounting methods for spreading the cost of an asset over its useful life. But in the real world, a well-maintained property might actually appreciate in value rather than depreciate. So FFO strips away those paper losses to give you a clearer picture of the cash flow generated by the REIT's operations.
So FFO helps cut through the accounting fog and see the real earning power of a REIT.
Exactly. Another important metric is net asset value, or NAV. This is like taking an inventory of everything the REIT owns. It's properties, cash, other assets, and then subtracting any debts. It provides a snapshot of the REIT's underlying worth.
So if a REIT's share price is significantly lower than its NAV, could that be a sign it's undervalued? Like finding a hidden gem in the market?
It could be a signal, yeah. But it's not like a guaranteed buy signal. You always want to consider other factors and do your due diligence. But NAV is definitely a valuable tool for assessing whether a REIT's share price is in the right ballpark.
I'm starting to see how these metrics provide a deeper understanding of a REIT's financial health. What else should we be paying attention to?
Well, you want to look at the dividend yield, which tells you how much income you're getting back relative to the price you paid for the share. It's a way to quickly assess the potential return on your investment. Higher yield generally means more cash in your pocket.
Now that's a metric I can get behind. What about the properties themselves? Are there any red flags to watch out for?
Occupancy rates are crucial. High occupancy means the REIT is effectively leasing out its properties and generating that consistent rental income. Low occupancy rates, on the other hand, could signal underlying problems. Could be with the properties or the management's ability to attract tenants.
It makes sense. A vacant building isn't generating any revenue. And what about the REIT's debt? Is that something we should be concerned about?
Absolutely. The debt-to-equity ratio is a valuable indicator of financial risk. It shows how much debt the REIT is carrying compared to its equity. A high debt-to-equity ratio could make the REIT more vulnerable to things like interest rate hikes or economic downturns.
So it's about finding a balance. Solid income potential, but with like a manageable level of debt.
Exactly. And never underestimate the importance of actually looking at the REIT's property portfolio. What types of properties do they own? Where are they located? Are they high-quality assets in desirable areas? A REIT that's heavily concentrated in a single property type or geographic location might be more susceptible to those sector-specific risks or regional economic downturns, right?
You've given us a lot to think about when it comes to evaluating REITs. But to put it all into perspective, could you give us some examples of well-known REITs that our listener might recognize?
Of course. Let's start with Prologis, ticker symbol PLD. They're a major player in the industrial real estate space, focusing on warehouses that cater to the e-commerce boom. Think massive distribution centers for companies like Amazon.
That's a name I've definitely heard before. What about the shopping mall REITs we discussed earlier? Are any of those considered major players?
Simon Property Group, or SPG, is one of the biggest names in that space. They've been adapting to the changing retail landscape by investing in outlet centers and mixed-use developments that combine retail with things like apartments and entertainment venues.
It's interesting to see how these companies are evolving to stay ahead of the curve. Now, what about residential REITs? Any familiar names there?
Equity Residential, EQR, is a major player in the apartment market, focusing on providing housing in major cities. Their performance is closely tied to factors like rental rates and affordability trends, which vary significantly across different markets.
Location, 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 as they say. Are there any other examples that showcase the diversity of REITs?
We could look at Public Storage, PSA, which owns and operates those, ubiquitous self-storage facilities.
I've never considered self-storage as an investment. But I guess there's always a demand for space. no matter what the economy is doing.
Exactly. It's a surprisingly resilient sector. And lastly, we have Welltower, which focuses on healthcare properties. As we discussed earlier, the aging population is driving strong demand for senior housing and medical facilities, positioning Welltower for potential growth.
So many different options. It seems like there's a REIT out there for every investment style and risk tolerance.
Absolutely, but no matter what type of REIT you're considering, it's crucial to do your research and understand the underlying fundamentals.
Okay, so let's recap what we've learned about evaluating these REITs.
Don't get caught up in the hype or just chase a hot stock. Look beyond the share price and delve into those key metrics we discussed: FFO, NAV, dividend yield, occupancy rates, and that debt-to-equity ratio.
Right. It's about understanding the business behind the ticker symbol.
Yeah.
What else is essential to keep in mind?
Don't forget about the property portfolio itself. Is the REIT diversified across different property types and geographic locations? Are they investing in high-quality assets that are likely to hold their value and generate consistent income?
It's like building a real estate empire, but with someone else handling the day-to-day management. Now, before we move on, there's one more aspect we should touch on: the tax implications of investing in REITs. What do you think?
You're absolutely right. It's an important consideration.
Taxes, right? Everyone's favorite topic. But seriously, though, understanding the tax implications is important for any investment. So what do you need to know about REITs and taxes?
Well, the good news is REITs are designed to be tax efficient. Remember that rule about distributing at least 90% of their taxable income?
Right.
That means a large portion of your returns will come in the form of dividends, which can be advantageous from a tax perspective.
Okay, so how are those dividends taxed? Is it different from, like, regular stock dividends?
Dividends from equity REITs are typically taxed as ordinary income, just like your regular salary. However, a portion of those dividends might actually qualify for a special tax deduction, depending on current tax laws. This is where things can get a bit complex. So it's always a good idea to consult with a tax advisor for specific guidance.
That's sound advice. Always best to get personalized advice when it comes to taxes. So we've explored the ins and outs of equity REITs, from their structure and potential benefits to the risks, and even how to evaluate them. Now let's talk about taking action. How does someone actually get started with investing in these REITs?
Well, getting started is easier than you might think. One option is to just buy shares of publicly traded REITs directly through a brokerage account, just like you would buy stocks. You can log into your online brokerage, search for the REITs ticker symbol, like PLD for Prology or SPG for Simon Property Group, and place an order.
So it's as simple as a few clicks.
Pretty much. Another option is to invest in REIT mutual funds or exchange-traded funds, known as ETFs. These funds hold a basket of different REITs, giving you instant diversification without having to pick individual companies.
That's a great option for someone who wants to spread their risk or isn't comfortable selecting specific REITs. Are there any other ways to invest in REITs?
You've got private REITs, but those aren't traded on public exchanges, so they can be a little more complex and less liquid. They often have higher minimum investment requirements and potentially higher fees as well, so they're generally not recommended for beginners.
So stick with the publicly traded REITs or funds for now.
Exactly. It's best to start with the more accessible options and build your knowledge before venturing into the more complex world of private REITs.
This has been such a comprehensive overview. Any final words of wisdom for our listener as they begin their REIT investing journey?
Well, knowledge is power, especially in the world of investing. The more you understand about REITs, their potential, and their risks, the better equipped you'll be to make informed decisions that align with your investment goals.
Well said. And remember, this is just the beginning of your exploration. Keep learning, keep asking questions, and don't be afraid to seek guidance from trusted financial professionals.
Couldn't agree more.
Now, to leave you with a final thought. We've talked about so many different types of REITs today, right? Which property type intrigues you the most, and why? What trends or opportunities in the real estate market make you lean toward one sector over another? Keep exploring, and who knows, maybe you'll build that real estate empire we talked about. Thanks for joining us on this deep dive into equity REITs. It's been a pleasure exploring this fascinating world with you.